Today, we're tackling a topic that affects millions of students and families on both sides of the Atlantic. How do student loans work in the United States versus the United Kingdom? If you've ever wondered why graduates in one country may feel more stressed about their loans than those in another, or how repayment rules differ, this video will explain everything you need to know. Stick around because we're going beyond just tuition costs. We'll break down how much students typically borrow, repayment systems, interest rates, and how these debts really impact graduates' lives. Let's start with the basics, tuition fees. In the United States, tuition fees vary dramatically depending on the type of institution. In 2025, the average annual tuition at a public in-state university is around $11,000. At a public university for out-of-state students, it's closer to $28,000. Private universities are even more expensive, averaging around $42,000 annually, and that's just tuition, not counting housing, food, books, and other costs. In the United Kingdom, tuition fees are more standardized. For most students in England, tuition is capped at $9,250 per year for undergraduate programs. Scottish students attending Scottish universities pay no tuition at all, while students from other parts of the UK studying in Scotland must pay up to $9,250. So while UK tuition fees are high by international standards, they are much lower than the sticker price of most American colleges. Next, let's talk about how much students actually borrow. In the US, student loan debt is a major national issue. The average borrower graduating in 2025 leaves school with around $30,000 to $35,000 in student loan debt, but many have much more, especially those attending private universities or graduate programs. In the UK, students typically borrow for both tuition and living costs through the student loans company. A typical graduate from an English university will owe around $45,000 to $50,000 upon graduation, but this figure can vary depending on location and length of study. So, interestingly, while the headline debt amounts look similar or even higher in the UK, the systems for repayment are completely different, and that makes all the difference. Let's break this down carefully. In the United States, student loans are treated like any other debt. You borrow a lump sum, and when you leave college, you begin paying it back with interest. Repayment typically begins 6 months after graduation, and the borrower is responsible for monthly payments regardless of income. Federal loans dominate the U.S. student loan landscape, and interest rates for loans disbursed in recent years are around 5 to 7%, though private loans may carry higher rates. Loan repayment is rigid. Unless you enroll in an income-driven repayment plan, you are expected to pay a fixed monthly amount until the loan is fully repaid. Missed payments can lead to delinquency, default, and damaged credit scores, which can affect housing, employment, and financial opportunities later in life. In contrast, the UK system works more like a graduate tax than a conventional loan. After graduation, UK students don't begin repayment until they earn above a certain income threshold. Borrowers repay 9% of their earnings above this threshold. For example, if a graduate earns $30,000 a year, they repay 9% of $2,700, roughly $243 annually, or about $20 per month. If their income falls below the threshold, repayments stop automatically. In addition, UK student loans are automatically written off after a set period, 30 years after the April following graduation for Plan 2 loans, regardless of how much has been repaid. So even though UK graduates may leave university with larger nominal debt balances, the monthly burden is typically much lower and depends entirely on their income. Let's talk about interest rates. In the US, interest accrues immediately after disbursement, and repayment periods can stretch for decades unless accelerated. Some graduates spend years just paying off interest without reducing the principal. In the UK, interest rates on student loans depend on income. In 2025, the interest rate for Plan 2 loans is capped at the Retail Price Index, RPI, plus up to 3%. So higher earners pay a higher rate of interest, while lower earners pay less or even no interest if their income is below the threshold. However, because payments are tied to income, it's common for many UK borrowers to never repay the full amount before the loan is written off at the 30-year mark. This means the UK system functions more like a contingent contribution based on income, whereas the US system operates more like a traditional debt repayment structure with little regard for ability to pay. Now let's discuss the psychological impact of student debt. In the US, student loan debt is often a lifelong burden. It affects when people buy homes, start families, or save for retirement. The existence of delinquency penalties and credit reporting makes student loans feel like a heavy obligation from day one after graduation. In the UK, many graduates think of their loan less as a debt and more as a marginal tax on income. There's no monthly bill unless you earn enough, no credit score penalty for non-payment if your income is low, and many borrowers expect their debt will eventually be written off. This key difference in perception has a major impact on life decisions and financial behavior between US and UK graduates. Let's touch on repayment flexibility and forgiveness programs. In the US, there are a variety of repayment plans. Standard 10-year plans, income-driven plans that limit payments to a percentage of discretionary income, public service loan forgiveness, which forgives remaining debt after 10 years of qualifying payments for public sector workers. But these programs can be confusing and subject to strict eligibility rules, and many borrowers struggle to navigate them. In the UK, there's no need to apply for income-driven repayment or forgiveness separately. The entire system is designed to adjust automatically based on income and forgive remaining debt after a fixed time period. Next, let's talk about government policy trends in 2025. In the US, student debt continues to dominate political debate. Some proposals aim to increase forgiveness programs or lower interest rates, while others focus on reducing college costs overall. But the US system remains complex, borrower-driven, and punitive for non-payment. In the UK, reforms are underway too. Recent policy discussions have proposed extending the repayment period from 30 years to 40 years and reducing repayment thresholds, effectively increasing the burden on future graduates, but still keeping the system income-based and with automatic write-off after a set period. Before we wrap up, let's explore some real-world case studies to illustrate how these systems work in practice. Imagine two graduates in 2025. Sarah in the United States graduates from a private university with $40,000 in student loans. Her repayment starts 6 months after graduation, and she's put on a standard 10-year repayment plan, which requires her to pay about $400 per month. If Sarah loses her job or her income drops, she must actively apply for an income-driven repayment plan to reduce her monthly payment, and failure to make payments can harm her credit score and lead to late fees or collections. Tom in the UK graduates from a university in England with $45,000 in student debt. After graduation, he starts a job earning $28,000 a year. Because he earns just above the $27,000 repayment threshold for Plan 2 loans, he pays 9% of $700, about $60 per year, or just over $5 per month. If Tom's income drops below the threshold, his repayments automatically stop with no paperwork needed. Even if he never repays the full balance, the debt will be written off 30 years after the April following his graduation. These examples show just how differently these systems impact individuals' finances and peace of mind. Next, let's talk about the role of parental support and cultural expectations. In the US, college funding has traditionally involved significant parental contributions, but rising tuition has made that harder. Many parents take out loans themselves, like Parent Plus loans, to help their children pay for college, adding an extra financial burden on older generations. In the UK, the system places much less expectation on parents to contribute directly. Student loans are widely seen as the primary funding mechanism, and tuition fee loans plus maintenance loans are designed to cover most costs. This means there's less intergenerational financial strain in the UK system, even though graduates themselves may carry large nominal debts. Let's dig deeper into loan forgiveness policies. In the US, Public Service Loan Forgiveness, PSLF, is one of the few significant paths to forgiveness outside of income-driven repayment programs. It requires 10 years of qualifying payments while working for an eligible employer, usually government or nonprofit. And the process has been criticized as complex, opaque, and plagued by application rejections. In contrast, the UK system builds forgiveness into its structure automatically. No separate application process is required. Borrowers simply stop paying when the term expires, and any unpaid debt is written off. This structural difference means that debt forgiveness feels accessible and predictable in the UK, but bureaucratic and uncertain in the US. Now let's look at student loan servicing. In the US, loans are serviced by third-party companies contracted by the government or private lenders. Borrowers often have to navigate confusing communications, inconsistent customer service, and administrative errors, which can result in delays, lost paperwork, or misapplied payments. In the UK, the Student Loans Company, SLC, is the single point of contact for nearly all student loan accounts, simplifying the system. Repayments are deducted directly from payroll for employed graduates through the IPAY system, so most borrowers have minimal direct interaction with the SLC unless they are self-employed or overseas. This means that UK graduates experience a more automated and consistent repayment process, whereas US borrowers must actively manage their loans and engage with multiple parties over many years. Let's also touch on the impact of inflation on student debt in both countries in 2025. In the US, rising inflation has led to higher interest rates for new student loans, increasing borrowing costs for incoming students. However, inflation indexing of income-driven repayment thresholds has offered some relief, preventing monthly payments from rising too quickly for existing borrowers. In the UK, inflation impacts interest rates directly. The Retail Price Index forms the basis for student loan interest calculations, So high inflation means higher interest charges, but because repayments are tied to income, this mostly affects how quickly balances grow rather than immediate monthly payments. In other words, inflation increases the total size of UK student loans, but does not affect day-to-day affordability. While in the US, it increases borrowing costs and can strain future cohorts more severely. Now let's look at overseas graduates. In the US, American graduates who move abroad must still repay their federal student loans. The Department of Education expects repayment regardless of residency, and income-driven plans still apply. Expat checking finances. Though managing loans from abroad can be logistically difficult, in the UK, graduates who move overseas must inform the student loans company and submit income information annually. Their repayment threshold is adjusted according to the cost of living in their country of residence. Enforcement can be weaker for those abroad, but HMRC and the SLC actively pursue collection for those who earn above the threshold internationally. Let's discuss graduate debt burdens by demographics. In the U.S., student debt burdens disproportionately impact women and minorities, reflecting broader inequalities in income, wealth, and access to higher education. Women hold around two-thirds of outstanding student debt and are more likely to struggle with repayment due to lower average earnings. In the UK, there are also disparities, but the income-contingent nature of repayments provides a built-in progressive mechanism. Those who earn less pay less, regardless of gender or ethnicity, and loans are written off after a set period no matter how much was borrowed. Finally, let's touch on how student debt shapes life decisions. In the U.S., student loan obligations often delay home purchases, marriage, having children, and retirement savings. The burden of large monthly payments plus credit reporting consequences has a measurable impact on financial behavior. In the UK, while student loan deductions reduce take-home pay for higher earners, the impact on financial milestones is smaller and often less psychologically burdensome because repayments adjust automatically and are viewed as just another payroll deduction. Let's summarize everything we've explored in this extended deep dive. U.S. student loans are higher in nominal cost, rigid in repayment, punitive for missed payments, and a major driver of household debt stress. UK student loans, while substantial in nominal terms, are repaid through an income-contingent system that minimizes immediate financial burden and includes a built-in forgiveness policy after 30 years. The U.S. system relies on voluntary borrower participation in programs like income-driven repayment and PSLF, while the UK system automates repayment based on payroll and removes the need for borrowers to manage their loans actively unless their circumstances change. Inflation increases costs in both countries but affects borrowers differently due to the structural design of repayment systems. The cultural and emotional experience of student loans diverges sharply. A heavy lifelong burden in the US versus a payroll deduction that many never fully repay in the UK. Ultimately, while both countries have large student loan systems, the borrower experience feels dramatically different from how repayment begins, to how monthly payments are set, to how loans are eventually resolved or forgiven. That's it for today's detailed breakdown of the student loan systems in the US and the UK. If you found this video helpful, be sure to subscribe and hit the bell because we have more educational comparisons coming from healthcare to retirement, taxes to inflation. And as always, I want to hear your thoughts in the comments. Are you currently repaying student loans? Which system would you prefer and why? What do you think governments should do to improve student financing going forward? Thanks for watching, and I'll see you in the next video.